Everyone wants to be wealthy. Almost no one wants to pay the price for it. Not the price you're thinking of. Long hours, hard work, risk. Those are the easy costs, the ones people brag about at dinner parties, the ones that make for a good highlight reel. I'm talking about the invisible price, the stuff nobody puts on a vision board. The comforts, identities, relationships, and even personality traits that quietly have to be set down before real money, the kind that compounds, that outlives you, that buys you freedom instead of just stuff, before that kind of wealth can walk through the door. This isn't a video about hustle. It's not about waking up at 4 a.m. or cutting out lattes. Those tactics get repeated so often they've become noise. This is about something deeper. The 8 things you have to consciously let go of if you want to build wealth that actually lasts, wealth that survives recessions, bad years, and your own worst decisions. Some of these will surprise you. One of them might make you genuinely uncomfortable. Stick with it. By the end, you'll understand why some people with modest incomes end up wealthy, and some people with impressive incomes end up broke. It was never really about the paycheck. Let's begin. The first thing you have to give up is the illusion of security. A steady paycheck feels safe. It isn't. It's just risk wearing a disguise. When you trade your only income stream for a single employer, you've concentrated your entire financial life into one point of failure. A company that can restructure, get acquired, change leadership, or simply decide it no longer needs you. You don't control the decision that ends your income. Someone in a meeting you'll never attend does. Real wealth requires you to trade the comfort of predictability for the discomfort of ownership. That might mean starting a business on the side while you still have a job. It might mean acquiring assets, real estate, equity, a stake in something, instead of just accumulating a salary. Ownership is uncomfortable because it's unpredictable in the short term. But predictability with no upside is not security. It's a slow leak dressed up to look like stability. Consider 2 people earning the same income. One spends 30 years exchanging hours for dollars with no equity, no ownership stake, nothing that continues generating value after they stop showing up. The other spends those same 30 years building something, a portfolio, a business, a piece of property that keeps producing value whether they show up or not. On paper, their salaries might look identical for years. Their outcomes will not. The people who build lasting wealth understand a simple truth. A job gives you income. Ownership gives you wealth. And you cannot fully commit to ownership while you're still clinging to the idea that someone else is going to take care of your financial future for you. Giving up that illusion is uncomfortable because it means acknowledging that your financial future is entirely your responsibility. No employer, no government program, no inheritance is coming to rescue you from the consequences of that realization. That's frightening. It's also the beginning of real agency. The second thing you must give up is instant gratification. This sounds obvious, almost cliché, but most people don't actually understand what it costs them, because the cost is invisible. It's not the $40 you spent on a night out. It's the version of that $40 compounding at 8% for 30 years, quietly becoming $400. Multiply that by every discretionary purchase across a decade, and you start to see why 2 people with identical incomes can retire with wildly different outcomes. Wealth building is fundamentally an exercise in time-shifting pleasure. You are choosing to feel less good today so you can feel exponentially better decades from now. And worse, you don't even get to watch it happen in real time. There's no dopamine hit when your index fund goes up 0.3% on a Tuesday. Nobody claps, nobody posts about the boring, disciplined contribution you made to a retirement account this month. Meanwhile, every purchase you don't make comes with real, immediate social invisibility. Nobody notices the vacation you skipped, but everyone notices the one you took. This is why most people fail at it, not because they lack financial knowledge, but because they lack tolerance for boredom. Wealth building is the unglamorous middle. The years where nothing seems to be happening, where the compounding is real but invisible, where your net worth chart looks like a flat line for a decade before it suddenly doesn't. That inflection point, where the curve visibly bends upward, is often called the point where money starts making more money than you do. Almost everyone quits before they reach it, precisely because the years leading up to it feel like nothing is working. If you need to feel rewarded now, you will always struggle to build wealth later. The two are, at some level, mutually exclusive. Learning to derive satisfaction from the discipline itself, from watching a number grow slowly and quietly, is a skill, not a personality trait. It can be built, but it has to be built deliberately, because nothing in modern life is designed to reward patience. The third thing to give up is subtler: the identity you've built around what you consume. In a consumer economy, we are trained from childhood to express who we are through what we buy. Your car, your clothes, your neighborhood, these become shorthand for status. And status, unfortunately, feels a lot like security, even though it's the opposite. Status is judged by outsiders looking in. Security is measured by what happens when nobody is watching and the income stops. Here's the trap. The people who look the wealthiest are often the least wealthy, because appearing rich and being rich draw from the same limited pool of resources, and every dollar spent signaling wealth is a dollar that can't compound. This is sometimes called the rich versus wealthy paradox. The wealthy often look unremarkable. They drive older cars. They live in the same house for 20 years. They wear the same jacket in photos taken a decade apart. Meanwhile, the person with the newest car and the flashiest wardrobe may be one missed paycheck from insolvency, held together by financing agreements nobody else can see. There's a reason for this pattern beyond simple frugality. Every purchase made for signaling purposes carries a kind of hidden tax, not just the sticker price, but the opportunity cost of what that money could have become if invested instead. A new car depreciates. A stock position historically tends to appreciate over long horizons. The gap between those two outcomes, repeated across a lifetime of choices, is often the entire difference between people who accumulate wealth and people who accumulate belongings. To build real wealth, you have to be willing to look, for a while, like you have less than you do, because you're actually choosing to have more than you show. That requires giving up the ego reward of visible success in exchange for the quiet reward of actual net worth. Most people can't make that trade. Their identity is too fused with their spending, and unwinding that fusion can feel like losing a part of yourself, even though what you're actually losing is a costume. The fourth sacrifice is harder to talk about because it touches relationships. You often have to give up, or at least step back from, the crowd that doesn't share your financial values. This isn't about abandoning friends. It's about recognizing that your environment shapes your decisions more than your willpower does. If everyone around you treats spending as entertainment, treats debt as normal, and treats saving as something you do later, you will absorb those norms whether you intend to or not. Financial behavior is contagious in the same way that habits around food, exercise, and even happiness are contagious. We calibrate our sense of normal based on the people closest to us, often without realizing it. There's a well-documented pattern here. People's spending habits, savings rates, and even their appetite for risk tend to mirror the 5 or 6 people they spend the most time with. This isn't superstition, it's social proof theory, and it's one of the most powerful, least discussed forces in personal finance. It explains why financial behavior often runs in families and friend groups long after the original reasons for those habits have been forgotten. Building wealth sometimes means fewer nights out or spending them differently. It might mean surrounding yourself with people who talk about investing the way others talk about vacations. It doesn't mean judging people who spend differently than you, and it doesn't mean cutting anyone off. It means being honest that if your environment is pulling you toward consumption, your bank account will follow, no matter how disciplined you think you are in isolation. Willpower is a finite resource. Environment either works with it or constantly drains it. The fifth thing you must give up is your ego's need to be right, especially about your own decisions. Every investor, every entrepreneur, every builder of wealth eventually makes a decision that turns out to be wrong. The market drops right after you buy. The business idea doesn't work. The property doesn't appreciate the way you projected. What separates people who build wealth from people who don't is not that they avoid these moments, it's that they don't let their ego dig in and defend a losing position out of pride. The willingness to say, "I was wrong, I'm cutting my losses," is one of the rarest and most financially valuable skills a person can develop. Most people hold on to bad investments, bad business decisions, and bad financial habits far longer than they should, simply because admitting the mistake feels worse than the ongoing cost of the mistake itself. This tendency has a name in behavioral finance, the sunk cost fallacy, and it quietly destroys more wealth than almost any single bad investment ever could, because it compounds bad decisions instead of correcting them. Wealth requires humility. It requires treating your own past decisions as data, not identity. The moment your net worth becomes tied to being right, you've made your ego a shareholder in your financial decisions, and your ego makes a terrible business partner because it optimizes for feeling validated, not for making money. The sixth thing to give up is the false safety of inaction. Not deciding is a decision. Leaving money in a checking account earning nothing is a decision to lose value to inflation. Not negotiating your salary is a decision to accept less than your worth year after year, compounding into hundreds of thousands of dollars over a career. Not starting the business, not making the investment, not having the difficult conversation about money with a partner, these all feel like safe, neutral choices. They are not. They are just risks you've chosen not to see. And unseen risks are often the most expensive kind because you never get the chance to manage them. Real wealth builders develop a habit of treating inaction as its own category of risk, one that has to be weighed against the risk of acting. This reframing changes everything. Suddenly, playing it safe doesn't feel safe anymore, and taking a calculated, informed risk starts to feel like the more prudent choice. The seventh sacrifice is one people rarely say out loud. You have to give up a meaningful amount of leisure time, at least for a season. This doesn't mean burning yourself out or glorifying exhaustion. That's a different, more damaging myth. But building an additional skill, a side business, or a deeper understanding of investing requires hours. Those hours have to come from somewhere, and for most people, they come from the time currently spent on entertainment. Television, scrolling, passive hobbies that consume attention without building anything. The uncomfortable math is this. You have roughly the same number of waking hours as anyone who has ever built significant wealth. The difference isn't time itself, it's what fills it. Every hour spent developing a skill that increases your earning potential, researching an investment, or building a side income stream is an hour that isn't available for passive entertainment. This trade-off is temporary for most people, a season of a few years, not a life sentence, but it is real, and pretending it isn't is one of the most common reasons ambitious plans quietly die. People want the outcome of the sacrifice without making the sacrifice itself. The people who successfully build wealth on top of a full-time job or family responsibilities almost universally describe the same experience. A period of years where free time essentially disappeared into the project. It wasn't sustainable forever. It didn't need to be. It only needed to last long enough to build the asset, skill, or income stream that eventually bought back that time with interest. And finally, the last and hardest thing to give up, your short-term definition of success. Real wealth is not built in a quarter or a year or even 5 years. It's built across decades through consistency that in any single moment looks unremarkable. This is deeply at odds with how our culture defines winning. We celebrate the quick flip, the viral business, the overnight success story, ignoring the fact that most overnight successes are the visible tip of 10 invisible years. You have to give up needing wealth to arrive on a schedule that matches your patience. It won't. It arrives on the schedule of compound interest, of market cycles, of businesses maturing, of relationships and reputations solidifying. The people who build the most durable wealth are the ones who make peace with a long, undramatic timeline and who find a way to enjoy the process itself. Because the process is most of the journey, and if you can't enjoy the process, you'll spend decades waiting to be happy. So, here's the uncomfortable truth this video is built around. Wealth isn't primarily a math problem. If it were, everyone with access to a calculator and a savings account would be rich. It's a subtraction problem. What are you willing to give up? The illusion of security? The dopamine of instant gratification? The identity built on spending? The crowd that doesn't share your values? The ego that needs to be right? The false comfort of doing nothing? The leisure time you've grown used to? And the short-term definition of success that our culture keeps selling you? None of these sacrifices are easy. If they were, everyone would already be wealthy. But that's exactly the point. The difficulty is the filter. It's why real wealth remains rare, even in one of the most prosperous economies in human history. It was never actually a secret. It was just expensive, in currencies most people weren't willing to spend. The question isn't whether you have what it takes to build wealth. Most people do, mathematically. The real question is whether you're willing to pay a price that isn't measured in dollars. If this resonated with you, subscribe, because next week we're covering exactly how to start replacing those sacrifices with systems that make wealth building automatic, so discipline stops being something you have to summon every single day. See you then!